Has anyone ever tried to sell you a whole life insurance policy focusing on the cash value benefit? They explain it as a safe, liquid, tax-free area to position money. Look at the dividend interest rate that the company's paying. I've got all of these great benefits. Banks, the elite, large corporations have put money into cash value life insurance products for decades, over the past 100 years. Ever hear this? It's a common pitch when it comes to whole life insurance. And there are some truths to that. When you look at banks, they position a boatload of money into cash value life insurance products. Take note that I said cash value, not whole life insurance products. Banks do things a little bit differently. When you look at corporations, they often do use whole life insurance products. However, the whole life insurance product that is often proposed to a corporation is not proposed to an individual. It can be proposed in an identical fashion, where I've got a product that's set up with maximum cash value from day one for a corporation, and then an individual is shown something different. That often causes a lot of friction in the industry and a lot of agents and people in different industries, financial advisors versus insurance brokers, fighting each other because a lack of transparency exists. It's not consistent. But my point is, it does work if it is set up properly, if I have full transparency when I'm examining the product. Another thing that I believe should be the case when looking at whole life insurance products, if you're interested in a policy, is should not have to be sold on a policy. It's simple as looking at the benefits. Is the cash value something I'm interested in? Maybe the death benefit, I'm interested in that as well. But from a cash value standpoint, kind of is what it is. If a policy is set up properly, it is a safe, liquid, tax-free area to position money. The net internal rate of return, which is the net growth rate over the life of the policy, will fall somewhere between 3 to 5%. If it's constructed properly, if it's with one of the top companies that have provided proof of performance on that, not just projections, there's a lot of things I want to be aware of. So in this video and the next several videos, we are going to provide awareness on whole life insurance policies, explaining exactly how they work. We're going to go through a lot of questions that people often ask. We're going to go through the core benefits, the safety, liquidity, the tax benefits. We're going to go through the loan features a little bit. Then we're also going to hit on objections. What are the drawbacks? What are reasons people don't do it? What are reasons people should not do it? Having awareness, this way again, I can see exactly how the product works and decide if it is a fit for me. Again, we often hear of people using these products like the elite and ultra wealthy, and they've got it figured it out to a degree. So if I can copy their model and execute things very similar to what I'm doing, that'd be great. However, am I being shown the same product that they're being shown? Or am I being shown the same product designed in the same way? Small little details that are quite important. Let's have some fun. So when it comes to a whole life insurance policy, we've got the basic overview or the outlay of it, which we've got a couple things here. We've got a death benefit. So with a life insurance policy, it does pay out a life insurance benefit. What that means, when I die, a death benefit is paid out 100% income tax-free to my beneficiaries. Take note that I said income tax-free, not estate tax-free. If I have a high net worth or large taxable estate, typically I do want to structure a policy or consider structuring a policy in a special type of trust that will allow me to leave money completely tax-free. But that does put some restrictions on the cash value benefit as well. But death benefit proceeds are paid out income tax-free. You'll notice with a whole life insurance policy that the death benefit over time will gradually increase. If I'm focusing on the guaranteed values on a whole life insurance policy, it will not increase. It's guaranteed not to go down, but it will remain level. Let me rephrase. Guaranteed not to go down, provided I continue to make premium payments. But generally speaking, if you do everything right, you'll see it go up, always has, still is today, if we do everything right from a funding standpoint. I'm going to explain what that means. We'll provide some info and visuals on that too. So a death benefit that gradually increases over time. As you make payments toward the policy, with any type of life insurance policy or insurance policy, what do we have associated with that? We pay a premium. That's the dollar amount I pay toward a policy, any type of insurance policy. Now, With a cash value life insurance policy, in this case a whole life insurance policy, you can actually choose where your money goes. It can be directed toward what's called a premium. Premium dollars typically do not build cash value in the early years, but as I continue to make premium payments, I do see that cash value build up. If you've ever been presented a whole life insurance policy, have you ever seen an illustration and you're paying in, call it $10,000 per year or any dollar amount? You've got zero cash value in the beginning. The years keep passing. Year 3, you start to see something. Year 10, you've almost got all your money back, but not quite. You still have less money than what you paid into the policy. That's a policy with 100% premium. That's a great example of what not to do if you're interested in a whole life policy for maximum cash value. If you're specifically interested in the cash value benefit, that's really what we're focused on. So money can go toward the premium piece or the PUA piece, which stands for paid up additions rider. Here's the fun part though with a cash value life insurance policy, or whole life here. When you hear whole life, what do you think of? I think of my whole life. I've got to pay premiums for my whole life. Not quite the case. A death benefit does remain intact for my whole life. The cash value continues to grow for my whole life. Some policies will require payments for my whole life. However, you can easily set up a policy where I pay into it for a short period of time. Maybe it's 5 years. Maybe it's less than that. A lot of people that have lump sum, that want to make lump sum payments, they've got a pile of money, maybe it's in cash, maybe it's another asset class, and they want to move it over to a cash value life insurance policy. They love the idea of taking that money, moving it into the policy, and being done. They're not into making payments for a long period of time. So you can do that with the proper policy, and if it's set up correctly. We're going to look at an example of someone funding a policy for 4 years in this video. But I can fund it for a short period of time. Maybe it's 5 years, 10 years, age 65. Maybe I start a policy and my plan is to pay into it up until 65, and then I decide to stop after 10 years. Maybe my payments go up and down. You can do that as well. Not the premium. This is typically level, but this PUA piece, which you'll see really accelerates the cash value growth, this is very flexible. I can add money to this rider or not. I can adjust it over time, each year. Very, very flexible. Different companies have different rules, which we cover in some other content and videos we have. But this is the key to really maximizing the cash value benefit. When we look at the cash value, what do we see here? What happens as time passes? Continues to appreciate. And you will notice by age 100, the cash value and death benefit become equal with each other. At that point, the policy endows, where the values do meet each other. Cash value and death benefit are equal. You could say you win at that point in time. You'll see the policy really pick up from a growth standpoint as well, but it's after I'm 100 years old. Most people don't look that far in the illustration. In any event, the cash value continues to appreciate over time. No risk at all. We're going to touch on the core benefits in the next video. But on that cash value point, this is the point of interest to so many people. How do you maximize it? That's always the question that comes up. And when corporations consider these products for themselves as a company, policies are often placed on their executives and employees. They're looking to maximize this piece here, the PUA rider. So here's exactly how to do it, or information to be aware of. We have videos on policy design that really break what I'm going to go through here. It breaks it down thoroughly. This is a quick overview. With the design in gold, if you're interested in cash value, let's assume you want to pay in $50,000 per year, but you do not want to be obligated to pay $50,000 per year. If you purchase a traditional whole life insurance product with a premium, base premium of $50,000, another name for the premium here is what is referred to as the base premium. If the base premium is $50K, that's what I have to pay each year. The base premium is $5,000, that's what I have to pay each year. So premium dollars, we've got less equals more. A lesser premium equals more cash value. The reason why is I can put more of my payment, let's assume in this example, you're paying in $50,000 per year. That's how much you want to be able to pay into the policy each year. Of the $50K, where can it go? It can go toward the premium or the PUA rider. we're going to assume we put $5,000 in the premium and then $45,000 into the PUA component. It'll actually be closer to $44,000. We add term insurance as well. That has to do with this guy, this MEC limit on the policy. But what do we see here? Less equals more. Of the 50K, if I put all of that 50,000 toward the premium, I would see next to nothing show up in cash value right off the bat. Or maybe 15 to 20%, depends on the product that I use. But this does not show up in cash value immediately. And in addition to that, it obligates me to a higher dollar amount. So how low can I go? Well, you'll find for a lot of the top companies, your major mutuals, a Mass Mutual, Guardian, New York Life, or Northwestern Mutual, I can push that premium often as low as 10%. So what that means, now I've got a minimum premium, which takes the smallest bite out of my cash value initially, so I see more equity show up in cash value. And in addition to that, I'm not obligated to this large dollar amount. Question we get so often, and this is for someone paying in $50,000 per year, for people that pay in $5,000 per year, and for people that pay in $500,000 per year, is they always like the ability to pay in a certain dollar amount. In this example, 50K. But I don't want to be committed to it in the event life happens. So if it's set at a number that never feels like a burden to me based on my personal scenario and circumstances, well, now I can easily commit to that. And then at discretion, I can throw more money into the PUA component, hyper growing my cash value. Interesting stuff, isn't it? As we look at this scenario, what you will see is this is going to be on a 50-year-old individual. This is going to be the same policy, same company, same health rating, same product, everything's identical, same out of pocket for the individual. He's going to fund it at $50,000 per year for 15 years, up until the age of 65. But the only difference here is we're going to look at how this product is designed. Where is his money going? So if you're interested in a policy and cash value is your goal, this is exactly what you want to look for. So on the left, we've got a traditional policy where we see $50,000 going in. Of the $50,000 payment, his first year equity, cash value, money that he has access to is what? $14,000 and change. The next year, he makes a $50,000 payment. His cash value grows from $14,000 and change to $42,900. If this is you, did you get the 50K back this year? No, you got less back than what you paid in. How about the next year? $42,900 to $87 and change. He paid in 50 grand. If you pay in $50,000 and you just get the $50,000 back, no earnings on top of it, that would be $92, but it's not the case. What happens here? Well, eventually, I start to see it grow by more than what I pay in. But down here, what's highlighted in yellow represents my break-even point. When I have equal or greater cash value than what I have paid into the policy. This is one of the biggest pain points for individuals. When they're told you've got a policy set up for maximum cash value, look at all of the benefits. They specifically ask, can I get the cash value stronger? And they're told they cannot. And they find out after the fact they can. That's the pain point right there. So over here, we've got the same policy with the same company, minimum premium payment. $50,000. So we've got the same net payment. But look at this right off the bat. $44,000 in change compared to the $14,000 in change. You got 30 grand more. The only difference here is the fact that we designed the policy different. So as we look at this guy, on the example on the far left, of that 50K, remember where the money can go, premium or PUA? Here it's all premium. Here, I've got a $5,000 premium. Everything else is allocated toward that PUA rider to hypergrow the cash value. There's a term insurance rider attached here as well. We actually have the full breakdown of the illustration. Here we go. There we go. So we've got the 5K base premium. Here's a term insurance rider, $660 and change. There's a little bit more term here in this listener rider as well. My point is we've got a policy that is completely tricked out for minimum premium, maximum cash value, copying that corporate model. Right? When I say corporate model, you'll see it in the title here, traditional policy versus corporate policy structure. So as we look at the same everything here, same company, same dividend crediting rate, funding it up until age 65, which option would you rather have, assuming cash value is your goal? That's why you're interested in a whole life insurance policy. Break-even point. What a difference, huh? Just by redirecting where our dollars are going between years 4 and 5 instead of years 10 and 11. Age 65, there we go. Cash value continues to appreciate thereafter, and we just see it keep on going up. So we've got a policy here that's designed for maximum cash value. Again, how do I beef up that cash value benefit, which will also beef up your long-term death benefit? And that's exactly how to do it with a minimum premium there. We mentioned we're going to look at a lump sum scenario, someone who funded a policy for 4 years. We're going to pivot to a different product here, actually. And we're going to look at the current dividend interest rate. Different product and company, I should say. Current dividend interest rate. And then the same product, but with the worst case scenarios, just the guaranteed values. What do things look like there? Always good to look at the worst case to properly set expectations. So here we see a net out of pocket of $250,000 per year for 4 years and not a penny thereafter. So his premium, $25K per year, he's not paying that at all after the 4th year. Still due through the 7th year, but he's not paying it. It's being paid internally through the company, through the policy's dividends and guaranteed rate. Well, my point is, his out of pocket right here is 0 each year. Yellow represents his break-even point. Paid in $1 million, I have $1 million. Doesn't pay a penny into the policy. What happens? Cash value continues to grow. Now we'll hit on this in later videos, but we've got that dividend interest rate of 5.65%. We never earn that much. Dividend rate is always a gross rate credited after the company's insurance expenses. I need to account for the death benefit and such as well. What I want to look at here is what is referred to as my internal rate of return. That's the net growth rate. And we'll hit on that in a later video. My point here is as you look at this, 4 years in, there's your cash value and death benefit that continues to appreciate over time. So we look at the worst case scenario. Do we see a difference? Yes. When's your break-even point? Between years 8 and 9 in this particular example. This is worst case scenario here, which we've always seen the products do better when they're designed properly, but at the same time, it is beneficial to look at the guarantees. If you feel like you have to pull teeth just to get those values, that's where we're going to feel like someone's hiding something from us. Just show the worst case scenarios, right? That's how I look at it. You'll also notice that the death benefit does not appreciate at all if we're not paying it when we look at the guarantees. If we continue to add money into the PUA rider, growing the cash value further, then we will see the guaranteed death benefit grow along with the cash value. But just to look at different scenarios, we see positive appreciation there. In a life insurance policy, the death benefit is paid out completely income tax-free as well. So hope this video helped. The main purpose was really just to show how to take a whole life insurance policy that's typically unattractive to many people and make it very attractive. And really the key is, how do I reduce the insurance expense, the insurance premium, and get more money toward the PUA rider? One last thing I forgot to touch on that's valuable, particularly in this case, anyone's case, is with this particular company that he's looking at, a lot of companies allow this, he can commit just to this. We have to add term insurance as well. We can cover that. I would just search any of our policy design videos. That goes through a full breakdown on that. But his true minimum commitment here might be $27,000. And then everything else, you can add 100% at leisure. Meaning I can throw money into the policy if I want to, but I am not obligated to do so. So now I take an insurance policy which typically is boring to many people, and flip it into a flexible savings asset. I can add additional funds when I want to, based on my cash flow and when it comes in, instead of being told by the company, here's the amount you must pay now because this is the bill you received. Fun stuff, right? Where we can make it very flexible. That's on that PUA component. And different companies have different rules here too. For example, of the major mutuals, Guardian is a company that lets you throw PUAs into the policy anytime you want. Mass Mutual, if you use the proper riders when you design it, will allow you to make adjustments one time per year without any medical underwriting. Just different companies have different rules, and I want to be aware of the different options as well. I hope you enjoyed this one. I had a ton of fun with it. We are going to cover quite a bit of material in the following videos. If you enjoyed this one, please hit the like button, subscribe for more, and as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.